Morning, everyone. Thank you for attending. Looking forward to today's webinar. Just going to wait, 30 seconds or so for let everyone trickle in, but it looks like we already have a pretty good showing here. Basically what this is, and we've talked, I think, more like one-on-one meetings with you all after we do these due diligence visits, but I'd say since about 2022, 2023, we've been going up. Either one or both of us, Jeff and I, go up to T. Rowe Price Baltimore for a 2+2.5 day due diligence meeting where we get to sit down with the portfolio managers, their analysts, their strategists, and it's a pretty intimate setting. There's kind of a group setting, but then there's also time at dinner, cocktail hour to talk one-on-one with a lot of these individuals, and you get a real sense of the culture. And we just think very, very highly of T. Rowe Price. If you look at their track record going back to, when they started in 1936 by literally T. Rowe Price himself, I mean, they, over long time periods, the majority of their strategies, I think it's like three-quarters, have outperformed their peer group, their benchmark. And the biggest kind of driver of that is that they have a 280 kind of analyst pool, group of analysts that aren't just kind of sitting there crunching numbers on a spreadsheet. They are out in the field. So to start at T. Rowe on the analyst track, you cover a specific industry, and that's the only thing that you do. And so some of those analysts can be career analysts, where that's all they do is work in one specific industry or sector. And we've met with some of those individuals. They're incredibly bright. And then some of them go on to kind of, if they've been successful as analysts and want to move into that portfolio manager role, they can migrate into that. But, they get, I think, they recruit from the top schools. But the thing that I've noticed over the years that's most unique, and then we'll get into kind of some of the slides talking about the specifics of what they talked about, is there's a very much a culture of humility there, right? So they have some of the managers, frankly, portfolio managers who don't need to work anymore. I mean, a lot of these individuals are very, very successful. They have a lot of money in their own funds, but they're still doing it because they love it. I think it's for them, it's like something that they were wired to do, right? It's not as much of a job as it is an identity. And just the question, when you ask questions, you get a really good sense as to the type of people they are, and they're very humble people. And so that stuck out to me and stood out to me. And I think that that's important for us culturally, because I think that, we try to have that same mindset of, being intellectually honest and curious and humble about what we don't know. All right. So same format as always. You'll have a chance to ask questions. We encourage you to ask questions. We may not know all of the answers. We're covering a very wide range of information, as you'll see, but we can get you the answer. And then if you want to ask a question, you just go to the Q&A box. You can either be anonymous or have your name listed. Type in the question. This is also being recorded, so we can send it out through our YouTube channel to you kind of at a later date. So we'll go ahead and get started here. I'm going to share my screen, and if anyone has any issues seeing my screen, hearing us, just let us know. But yeah, so this was from, what was it, early May? Early May. This time I went up, Jeff and I are going back in June to meet with a couple managers individually, which is really special. But, they talk, T. Rowe doesn't have a house view, right? But I think if I were to try to summarize what they're saying is they have, obviously they are kind of steeped into fundamental research. And fundamental research, if you think about what that is in the investment business, that's the kind of the Buffett side, the Buffett school, meeting with management, understanding a company from the bottom up, right? Revenue, expenses, capital expenditures, the industry they're operating in, all that, right? Bottoms up analysis. But with the advent of technology and quantitative modeling, right, quantitative investing has become a much, much bigger thing over the last 5, 10 years, especially the last 5 years. And T. Rowe has kind of embraced that quantitative side of investing. There's parts of T. Rowe that have been doing that for decades, but I think now it's becoming more widespread across the organization. So we'll talk about that, where they're finding alpha, where they're concerned. Um, and I will do my best to avoid too much jargon. I know that's very annoying for you, and we don't want to do it. It's just sometimes hard to avoid. As always, with any presentation, it's important to know that there are certain disclosures that we are going to mention some individual companies in this presentation. Nothing should be construed here as investment advice. This really is informational purposes only. If we don't have a relationship with you specifically, none of this is deemed advice. And even if we do, come to us individually and talk to us with any specifics and any questions you have. Okay. So one of the Sebastian Page, who's their chief market strategist, I think he leads the asset allocation committee. So T. Rowe manages up $1.6 trillion, right? So they're a very, very big asset manager, been around almost 100 years. And the thing that they kind of open with is it's kind of the market is in a paradoxical state in terms of there's really bullish indicators, and you could make the argument there's really bearish indicators kind of all happening at the same time. On the bullish side, right, we still are in this kind of post-COVID government spending, fiscal stimulus environment, right? We got a big tax bill that got passed that was stimulative. We still have the CHIPS Act that's ongoing. Build Back Better. There's a lot of kind of fiscal stimulus that is driving the economy still in a positive direction. The second one, which is equally as big, frankly, if not more than the fiscal stimulus, is the massive amount of capital expenditures that we're seeing on AI, right? I think the hyperscalers, which is, the Microsoft, the Amazons, the Metas, the Googles are expected to spend $700 billion, roughly $750 billion this year, and it's projected in 2028 to be $3 trillion. I mean, these are eye-watering numbers we're seeing, and it's why every headline you see in the news and about the market is AI, AI, AI. It is a big deal. Huge amount of capital expenditures are being spent on the data centers, the energy infrastructure, the chips. Okay. And then the third thing, which is really, really important, is the wealth effect, which is I think the average American is hurting a lot more in this higher inflationary environment than, frankly, most of the people probably on this call, most of the people we deal with, even people living in this area. But the truth is, in terms of what drives the market, what drives the economy, the top 20% of income earners drive more than 50% of overall consumption. Right, so there's societal impacts to that are certainly not good. We fear that could get worse, that split. But in terms of the economy, right, those people in that top 20% are going to be less price sensitive when they fill up their gas tank or booking an airplane, because while the cost is going up, they can still afford it. And then, of course, you have earnings, which have been very, very strong. We've had 6 consecutive quarters of double-digit earnings growth. So that's the positive side. And then Sebastian went on to kind of, what's concerning out there? So the bear indicators, right? The bear meaning not good. Yield curve, right? So you're starting to see the yield curve, which was very high on the low end, short on the long end. It's now kind of a quick steepening of that, where you're seeing the 10-year kind of pushing towards almost that 5% level. Historically, that's a recession signal. But as he jokingly pointed out, yield curve inversions and disinversions have predicted 8 out of the last 5 recessions, meaning they can cause a lot of false alarms. Jeff and I always talk about that. And then, are we in bubble territory? That's a tough word, but I think if you just look purely on valuations, the price per dollar of cash flow in the market is actually higher now than it was during the late 90s peak, which is like, oh my God, everybody run for the hills. But what you have to remember is it's actually rational that we would be priced more expensively today than then, because the actual profit of these companies is roughly double, if not more, than what they were back then. So you're generating a lot more cash flow per company per share, which is driving the premiums. And right, the economics of some of these companies are very, very attractive, right? At least historically, they didn't have to, right? They could essentially write a piece of code and sell it a million times, and they have incredible margins. And there's still some of that going on. It is changing with AI, but that is, market's not cheap, right? It's not cheap historically. It's not cheap based on anyone's metric. And then, what's going to happen with unemployment? So unemployment has risen from kind of the lows up to 4.3%. It's kind of sitting there and being pretty steady. But, what happens with that? There's predictions about, a lot of white collar workers losing their jobs. We will see. I'm a bit skeptical of that. But there's certainly a concern of what are the hidden employment risks. Mm-hmm. Anything to add?
No.
Okay. And then the next kind of big picture macroeconomic data point that we're very attuned to, and I think this is reflected in portfolios, is there's an asymmetric risk of an inflation shock. And I think you actually saw that over the past couple months with the crisis in the Middle East and what's happening with Iran. But there's a much, if where we sit now is kind of at this sticky but stable inflation, there's a real possibility, asymmetrical possibility that inflation kind of moves to the right, where it doesn't just kind of stay at this level, it pops up and then it stays there. And that could be, right, as a result of the tariffs, as a result of the AI spend, as a result of continued oil supply disruptions. But the risk to that direction is significantly higher than the risk of we're going to go back to the pre-2020 sub 2% inflation realm. And I think that's a big shock, right, to so many people, because for almost 15 years, we had an inflation environment where yields were super low, inflation was super low, and corporate earnings were still very good. And there's still some of that, I think, mindset as we go into the 2020s, but it's becoming more and more of a distant past.
And I think to sort of just pull that string a little bit further, historically, we've kind of grew up in the business thinking stocks, bonds as sort of like the two asset classes. One give you growth, one give you protection, and stability in the portfolio. But now in terms of if inflation, the risks to inflation are on the high side as opposed to disinflation or deflation, which is what we saw like through the financial crisis, for example. Now all of a sudden, from an asset allocation standpoint, maybe you do want to have something like commodities, like some gold exposure, natural resources exposure, as opposed to just sort of your plain vanilla stocks bond mix. So it does have asset allocation sort of implications.
Fantastic point. Thank you for bringing that up. Right, treasuries used to be, we just hold treasuries, that'll be our diversifier, but that didn't work in 22. Frankly, it didn't work earlier this year. You have an inflation shock, stocks and bonds go down, which bolsters the case. And the thing they were saying is having some exposure to real assets, and just certain hedges in the portfolio. One of the themes that was talked about at T. Rowe was diversifying your hedges, which is something we've been giving a lot of thought to. So thank you for adding that. So this is kind of goes back to the beginning slide, which is the marrying of quantitative analysis and fundamental analysis. And one of the points they made is to why this is so rare to put these together is that most bottoms-up fundamental shops, right, they actually have disdain and don't want to be near, right, the kind of the quant side. They're like, no, I trust my judgment. I'm meeting with management. I'm looking at the numbers. The quant side's only going to distract. And the quant side doesn't want to deal with the fundamental side because it's filled with too much human error and human judgment. And so what happens is culturally you get these firms where they gravitate to one or the other, but they rarely kind of can marry the best of both. And many managers at T. Rowe are starting to do this. And I think we're going to show you some case studies, but some really good examples where the fundamental can be used to then feed it into the quantitative to see, okay, is the sizing of this position make sense based on the quantitative data of the market today? And then you sometimes can have a screen that's done quantitatively that picks up on a company that because it's not covered by that many analysts, was flying under the radar, and then the fundamental team looks at it and says, "Oh, there's some real teeth here. This has we can build a real thesis around this," and then they end up buying it. So I think from a risk standpoint, sizing perspective, screening quant has a really valuable role, and then on the fundamental side, boots on the ground, we still strongly believe is a huge thing. So it's the integration of this that they're doing more of. Some of the best, I think, funds managers, asset managers are doing, but it's still, I think, a minority at most shops. So this is just kind of how that engine works in practice. So on the quant side, they gave an example where their quant screenings identified a company called Belfuse, which was like $1.5 billion company. They make like the connectors that go into, chips, basically. Okay. But small company, very industrial, very cyclical, volatile earnings. And the quant screen saw that they had this massive improvement in their operating margins, like 1,300 basis points, which was like 13% expansion. And the quant team screened it and said, "Hey, like, this is, we found this." And then the fundamental team looked and says, "Oh, wow, like something actual real is happening here." And they liked it. So they got it at 85. It got up to 300. I think it's like 260 now. Right. So this is where quant identified a company largely because of the massive amount of spending was happening in AI. And then the fundamental team looked at it, met with management, looked at the number and said, "Okay, yeah, this makes sense. This wasn't just a one-off anomaly where margins expanded and it's going to go right back down. This has more legs than that." So anyway, I thought that was a really interesting example they gave. And then another one, where the fundamental team led, was a uranium company, Uranium Exploration Corporation, and they're kind of the biggest miner of uranium in the United States or in North America. So analysts identified a massive underpriced supply-demand dislocation, right? If you think about kind of what's happening to the grid, to power needs, funding this AI boom, like energy is a huge constraint. And the quantitative model showed weak momentum, but the fundamental thesis was so compelling that they actually overrode kind of the algorithm. And this company, this stock was mentioned across multiple different managers and different strategies. So I think that's a really good example of where their platform, even though you may have different views, different managers can still own the same stock because there's such high conviction. And I think one of the things that was mentioned, we're meeting with a manager of a fund who just does natural resources a couple weeks, is he said, "I don't want to have to pick the best small nuclear modular reactor company like that stuff, but they all are going to get it from UEC." And so that was his kind of logic. They're all going to get it from here. I want to own. I think the other big player in this space is X Energy. They mentioned X2, but UEC was the big one. So another theme that emerged was just, right, markets change over time. They're not static. Things can rhyme, but they don't stay the same. And so the era of the 2010s, where you had low inflation, low yields, and you had companies that essentially were so asset light, they could build an algorithm, do code, and then sell it, billions of times over. Like you saw the rise of all these big software companies, these data companies, the Metas, the Amazons, all of it. That was the 2010s. And it led to, a market that was basically powered by FANG and then MAGA and then MAG 7, whatever the terms are. But it was all about low inflation, passive indexing kind of won the day. And some of those things are continuing. But I think the biggest difference as we move forward in a post-COVID world is those same big companies that were able to write code and sell it thousands of times over, they can't do that anymore. There's an AI arms race going on, and they have to invest hundreds of billions of dollars each, right? In other words, there's a tremendous amount of physical infrastructure that is needed to fund their next leg of their growth. And that results in, right, you have a much more a broader market, right? Because if you think about it, that trillion plus dollars has to go somewhere, right? It has to go to energy companies. It has to go to data center. It has to go to chip companies. It has to go to connector companies, grid companies. So that's a huge change that the companies that led and were really asset-light companies are actually now much more asset-heavy. So you're seeing larger market breadth, more tangible infrastructure type companies. And this is a huge one from a macro perspective. We're seeing higher inflation, a little bit more volatile inflation. And so all of this we think lends itself. It doesn't mean abandon passive. It just means we think, thoughtful, active management with valuation discipline in a market that where the seven biggest companies comprise, 38% of the entire market. Yes, that has worked, but there's a much higher cost of entry now to buy those companies today, and those companies are dealing with law of large numbers, right? For Nvidia to go from 5 to 10 trillion, could it happen? Sure, but that's essentially them growing by 2 times Japan's entire GDP. I mean, these are huge hurdles that these companies need to continue to jump over to continue their returns. It doesn't mean they couldn't do well. It just means if you look at history and you're a student of the market, when market concentration reaches these peaks, a lot of times it means there's a pivot. Was the Nifty 50 in the 70s that happened after that? It happened after .com in the 90s, right? So it happened after 2008, where we saw with energy as a concentration of energy, and then it went to tech. So
one of the interesting things is if anybody's inclined, if you look at a snapshot, the beginning of every decade, the top 10 companies in the S&P 500, and you go back and then just trace that every 10 years or so and look at how many new companies sort of enter and how many companies fall out. There's a decent amount of turnover. So the idea is basically when a company gets big, it's kind of hard to stay at the top, right? So, I mean, if you go back to 2008, right?
Yep.
Before the financial crisis, It was Exxon, it was GE, it was some of those companies, and then they quickly fell out of favor. And what replaced them was Microsoft, Facebook, Meta now, Google, Apple, et cetera. And those companies have largely stayed at sort of in the top 10 roughly for the past 15 years or so. And so that doesn't mean obviously that they can't continue, but what we're seeing now is sort of anomalous relative to kind of recent history.
Yeah.
So it is just to.
It's a fascinating time to be in our business, and I would even say if you look at talking Jeff's point is Nvidia wasn't there in 2010. Right. It wasn't even really there. But kind of the back half of the teens, it really started to pick up steam. So you could say that wasn't even there in 2010, and now that's the biggest company in the world.
Yes.
Right. It was Apple. I mean, Apple's still huge, but Nvidia's a lot bigger.
Yes.
So what's happening with this cycle, this super cycle? What's propagating it? Because it is bigger than the build out of the highways. I mean, this is industrial revolution 2.0, type of numbers that we're talking about here. So you're seeing a massive investment in compute, right? So hyperscalers, they have to do this. It is a classic prisoner's dilemma, right? They're not trying to win the poker hand. They're trying to win the entire casino. And if they don't play the hand, they can't win the casino. I mean, that's the thing. People are, you're going to lose all your chips. I'm not worried about losing my chips. I'm worried about losing the entire casino that I need to buy in order to win this thing. So that's what's driving, right, almost $1 trillion in capital expenditures we're seeing this year. So this is something that a tech fund manager mentioned, and it's basically what's kind of an odd thing that's happening is the more compute and money that they throw at these models, they are becoming more intelligent. We're not seeing a decline in that. Like there's just a direct, the more money they put into it, the more compute, it's leading to more intelligence. So how that's happening, we don't know, but the consensus amongst T. Rowe is that is happening. And then there's this race, right, to be the lowest cost provider, right, to provide infinite intelligence at near marginal cost. And what that is basically, and that has happened. Ironically, it's happened. It was $10 per however many tokens. It dropped, I think, over the course of the last year to like $2.50, and it's continuing to go down. The cost to companies aren't going down though, because the more efficient and the better AI is getting, the more it's getting used. And so there's still this concern over IT budgets and how much are companies going to be willing to spend on this stuff? Because even though the cost per token is going down, if you're using 100 times as much of it, it's still expensive. The biggest base case, the question, okay, what's the ROI? When is the ROI going to hit? The biggest kind of test case we have right now, and it's significant, is the ROI that we are seeing is within computer engineering, within software development. AI, coding, AI co-pilots are making software engineers definitively more productive. And I would say that's confirmed whether you're talking to people who work at these companies or actual clients we have who are computer programmers are saying without question, it's making me more productive. So we'll talk about this $600 billion increase in economic value, but you're already seeing, right, massive backlogs, right? Google backlog of almost $500 billion, Amazon backlog of 360 trillion. So as fast as it's being built, the demand is consuming it all almost instantaneously, which is very different than the dot-com era where they were building out fiber that, most of it was not even active. All right. It was all about this future demand. And then ultimately that demand happened, but it took much, much longer. Okay. Good. So how is kind of the different parts of AI, they're all these profits, the returns are not going to distribute evenly, and they could change depending on where we are in the cycle. So right now in the cycle, I think we're still very much focused on hyperscalers just spending the money, right? It's being captured by the semiconductor and semiconductor capital equipment makers. NVIDIA's, AMD, ASML, right? They're getting this revenue, very high margins, not that much competition. So, and then kind of beyond that, it's filtering through to grid companies, infrastructure companies, power companies, cooling companies, right? So this is a whole consortium of, the uranium company is an example of this. Eaton, would be an example of this in terms of what they do in the grid. Utility companies are an example of this. Electricity demand was flat for, a long, long time, or very increasing very marginally, and now all of a sudden it's ticking up materially. The models, right? So these are extremely capital intensive. They're getting a lot of funding from outside, venture firms and PE firms, and these could be, right? We don't know, but in 5-10 years, these could be some of the biggest companies in the world. We don't know. We'll see. But one thing that's shocking is Anthropic in 9 months went from $5 billion in annual recurring revenue to $30 billion recurring revenue. Those numbers are like, I don't think we've ever seen numbers like that before. Now they're also spending an insane amount of money too. But nevertheless, like on the revenue side, it is continuing to gain pace. Little bit odd, but one of the points that a tech manager made is it's not enough to be the model. Okay, the model is, you put into ChatGPT or you put into Gemini your question, it acts as a chat, but like that's table stakes now. What his point is it's the model and something called the harness. And the easiest way I could try to explain this is the model is kind of like the electricity flow. Like if they were to just sell kind of raw electrons during the electricity boom to a user, that's kind of what the model. The harness is the best analogy I can give you is more like it's the washing machine. So the grid was in place, the electricity flowed to this unit, but then the washing machine company made something that took those things and had a very specific purpose with an definitive value proposition for the end user. And that it's the model makers who can figure out the model plus harness that are really, really in this manager's opinion, going to have outsized returns. I think Anthropic is having some success with this in things like in Claude, right? You can tell Claude what you want, and Anthropic can kind of build it through Excel. I would say that's a good example of the model and harness. And there's some companies that are literally AI native built, and we're not saying we own these, we're not saying to buy them, but Palantir is an example, Perplexity is an example, where the model itself was built with the end value creation in mind versus just, a fire hose of information coming at you. So hopefully that's right. So where is the real returns, right? Well, depending on where you are in the cycle, it could be at multiple parts of these. But right now, right, it's physical infrastructure, and I think kind of at an end state, it's going to be having who has the best model plus harness. That I know that gets a little technical, but it did get technical. Anything you would add to?
Yeah, I mean, I think I was trying to sit here and think of an analogy for the internet, but I think a lot of people's interfacing with AI comes through, and us included, comes through kind of putting a prompt into like ChatGPT or Claude. Um, when you look at that and that's your experience, you think, what the heck are these companies spending $1 trillion on all of this? But that's not the end state. That's not where these companies, I think, believe that the massive opportunity in AI is. It's with agentic AI, and it's really so that there are these AI agents that are going out and kind of doing things on their own, as opposed to require input from us, give us an output, and then we look up whatever thing, an itinerary for a vacation we're going on or something like this. This is much more expansive in terms of like a productivity enhancing tool at the enterprise level or the company level. And I think most people, us included, are sort of utilizing on a daily basis. So I think it's hard in a lot of ways to conceptualize, what the vision here is when we just look at like a data center going up or just sort of interacting on a ChatGPT prompt level. This is, when Amazon or Alphabet, which is Google, or Microsoft are thinking about agentic AI, or NVIDIA's thinking about agentic AI, it's going to be much crazier, I think, than I guess our sort of use case up until this point has been.
Yeah. And I would say I talked with a gentleman recently who's a super smart guy. He's a computer scientist. He's been in the workforce for 15 years, and this is last week. And he basically said, I think I'm okay, but I wouldn't want to be a computer scientist coming out of school today because AI is uniquely positioned in software development to essentially, the way he explained it was, he writes the code, but AI can be used without a human to verify, okay, does the code work? And I guess that can run, kind of 24/7 across many different permutations. And he's like, we can still write the code, but I don't need to be there to run that. And previously, I guess I had to write the code to run it, and now AI can do that. So he was just saying there's no question it's made him more productive, and he doesn't see any issues for him in the next 5 years. But he said if it continues to get better, right, just nobody knows, right? Nobody knows how good it's going to get, if it's going to plateau. But the bottom line is like that's kind of our boots on the ground talking to an actual person who does this for a living, saying yes, it's existential for those coming into the market, and it is very, very well suited to kind of make software developers more productive. And here's kind of this they call it the $600 billion proof of concept. Again, it's numbers. This doesn't say, oh, this is definitely true, but I think this is kind of the math that they're looking at. There's 30 million coders in the world. Okay. The average salary of a coder is $100,000. That's $3 trillion of total spending that occurs on software developers. If we can agree that there's a productivity improvement of 20%, which has been cited by Microsoft Copilot for GitHub, which is probably the biggest use case. Some see it's higher than 20%. Let's just say 20%. Well, now you just do a simple math, 3 trillion, right, times 20% is 600 billion of new economic value created every single year. So just to put that in perspective, 600 billion a year is more than the entire software market currently. Entire software market. So yeah, like the numbers start to get staggering when you think about it. And this is just with encoders. So yes, it's expensive. Yes, there's a lot of question marks, but the spend is happening. The technology is advancing, and you have a pretty, in my opinion, viable proof of concept here just within software development. So the point here is if the return ROIC is return on invested capital, right? If high return on investment capital use cases like this exist over time, the AI token spend, right? What companies set their IT budgets at, they're going to do it regardless of what the constraint is because the value is there, right? They're going to spend $1 to make $1.20. Anything to add? The other big thing that was talked about is because we're at this point in the market where you have very, very high levels of concentration risk, the highest levels I think that we've ever seen, with these massive companies having incredible economics. They're widely covered by, there's an average of 60 analysts per every mega cap stock out there. So hard to find much big opportunity and undiscovered kind of value there. But in the smaller to medium size part of the market where companies are, 5 billion to 30, 40 billion even, those represent microscopic fractions of the overall market when you compare it to, the S&P 500. A good example that a BlackRock manager said recently to us is if you look at the S&P 500 today and you look at a $200 billion market cap company, that's not a small company. It comprises 0.2% of the market. And the reason for that is you've had these large companies, which historically, right, you kind of have, because of competitive forces, the larger a company gets, the more bloat there is, the more other companies can compete. That hasn't happened with these companies, the Metas, the Amazons, the Googles, the Microsofts. They've defied that. They've gotten bigger and bigger, and the economics have gotten stronger as they've gotten bigger. But again, now that we're going through this transition where they're spending a lot more money, right? We're in a higher interest rate environment. Opportunities are emerging kind of downstream with smaller to medium-sized companies. And the spread, the valuation, how much you have to pay for $1 of earnings in that area, that small and medium-sized area that's less well covered, is at one of its biggest dispersions ever relative to market large cap. 6 to 7% kind of differential in terms of forward returns. And that is starting. I mean, you're already seeing some of those smaller, medium-sized companies having outsized returns this year. So it is a bifurcated market. And I think from an active management standpoint, you do get a lot of opportunity in this small to mid-size realm. And we're not saying, we're going to abandon all this, but we think it's appropriate to have some position sizing targeting this part of the market. So here's a couple examples of analyst work that they shared, just kind of some of the things that they uncovered to give you a sense as to how these decisions get made. So the first example is they called it the sleeping monopoly, which is FICO. So for years and years and years, FICO charged almost nothing. I think 50 cents per FICO score to lenders, mortgage companies, people who ultimately sold to Fannie Freddie. And the housing regulations were such that they had to pull like 90% of these scores that were pulled were FICO. So they had a monopoly in the industry. And then they realized, wait a minute, like they're passing through this cost to the end consumer at like $50, $100, and we're only charging 50 cents. And the whole mortgage origination process is $6,000. So I think it was 2022, 2023, analysts, the T-word analysts were going to talk to them and saying, you have way more pricing power than I think you realize. Why don't you start? And so they did. They took it from 50 cents to $4.50, and then from $4.50 to $10. Stock went from $300 to $2,000. So it was those boots on the ground conversations, talking to banks and regulators, but also talking directly to management itself, and sometimes making these suggestions. They won't always take them, but clearly, right, that is the definition of pricing power right? They had a monopoly, charging almost nothing. Went up to $10. Frankly, the end consumer doesn't realize, they don't even get hit with that, and look at that value creation in the stocks. That's an unusual example. And then another analyst was he was tasked with covering Uber. And he was trying to figure out the unit economics of Uber relative to the other ride hailing companies out there, including some of the robo kind of the driverless taxis like Waymo, the Tesla as a robo taxi service that are out there. So what did this analyst do? Beyond his daytime job, he became an Uber driver, if you can believe it. So he drove his Uber for, I think, a couple months. And he basically was like, look, it's a very tough job. These people are paid minimum wage. They're not official employees. So they don't get benefits. It's a hard job, was his point. And the second thing that he did as part of that is he and his team went out to, I think it was Phoenix and LA or San Francisco. And they spent a week calling hundreds of different ride hailing services to see kind of what the pricing was, what the competition was. And what he walked away with is that Uber was being underpriced by Waymo and Tesla's taxi by about 60 to 70%. And he said the reason they can do that is because the biggest source of cost for these ride hailing companies is labor. Well, if you don't have that labor, you could be much more competitive on pricing. And so his conclusion, kind of as he exited and wrote his write up on Uber, was that he doesn't think long term Uber is going to be attractive because he believes that as technology advances and as autonomous driving becomes more mainstream, they won't be able to compete. And the other point he made on Tesla was that they also have the advantage of kind of vertical integration because they manufacture their own cars, right? So they can do more with pricing on that. And the other thing he said is that Musk is going to do whatever he has to do. He'll lose money for years to win that market. And so he just said Uber's going to have a really, really tough time. So the conclusion wasn't as interesting as the process that they used and the due diligence that the analysts and their team did to discover, right, whether they thought the investment was worthy or not. Okay. Again, this is just more a combination of when sentiment gets really, really hyped and really depressed, and where the actual economics are in a business and where it's going. And we know we have clients who are sensitive to fossil fuel use and climate change, and we totally understand that. This is just really just like at the investment side. So on the left side, you can see there's a company called Ørsted, which I think is a Danish company. An international manager mentioned it because he said during the green, they make offshore wind turbines and transmission lines for the wind turbines, but they were priced at $85 billion kind of during the COVID era when everyone said, okay, we're going green. The energy revolution has started. This is the future. So it went through a crazy speculative boom. And then when interest rates went from 0 to 5% coming out of COVID, energy costs, right, kind of everything changed basically. No one wanted to own that anymore. Oil was going up. Traditional energy companies were doing better. It dropped from 85 billion, 90% to 8 billion. That's a massive change. This is when the manager bought it. And it's currently for 35 billion, right? And so the idea here is that it was being priced for dead, and the manager and T. Rowe's viewpoint was, okay, yes, like wind is not going to be the only answer, but energy needs will continue, and they're a very good company. So bought them, and now it's at $35 billion. So not back to kind of where it frothed up and peaked, but certainly kind of much more in the middle range here. And then over here, energy, right? You've heard so many times about peak oil demand. It's been talked about for a long time. And I think many investors are of the belief that traditional energy companies kind of aren't, there's a term called, they might be stranded assets, right? Because if demand for oil and gas doesn't increase, you have all these assets out there that essentially become, worthless. But the data doesn't really confirm that. The data shows that energy usage of oil and gas is actually continuing to increase, not maybe at the pace it was, but as a percentage, it is going up each year, and that's confirmed by the EIA, the IEA, and so what the opportunity that some managers saw was, unlike in the U.S., where we have to essentially use shale technology to get oil and gas out of the ground, it's capital intensive, but when it hits, it's like you get a ton of money all at once and then less and less over time. But in Canada, they have something called the oil or tar sands, which are much thicker type of oil. It's got a lot of sand in it. I think some minerals that they have to extricate, but it is visible. It is literally just a mining project. And once they build the plant that can do it, it generates a very predictable source of cash flows for decades. Okay. Market's not pricing it like that. It's pricing it very cheap. And so this is the type of thing you're like, look, energy is a bottleneck. Oil and gas isn't going away. Hopefully it lessens over time. But here you have an example where you have Canadian oil producers that aren't in the same situation as domestic oil producers, but it's being priced the same way. So that's kind of that mismatch opportunity. Anything?
Yeah, I would just say with both of these examples, which I think are pretty powerful, when we talk about sort of generating investment returns above the benchmark, which we call like alpha, which is what T. Rowe Price, any sort of investment manager you pay, you kind of hope that they can achieve. There's effectively three buckets of advantages that they kind of fall in. One is informational advantage. And I think in today's age, there's certainly companies, BlackRock being one, they're collecting all sorts of interesting data that's sort of beyond like the 10K report that's public financial data. But obviously there are limits to that. If you go to non-public available information that's illegal, then you have an analytical edge. Some people, decades ago, like a Warren Buffett, he was able to kind of look at the public reporting and sort of talk to management or whatever the case may be and sort of develop an investment thesis. Now with the advent of AI and certainly with computing and the ability for computers to sort of put together analytical software programs and quantitative programs that kind of analyze information very quickly, that sort of edge is very difficult. The third sort of edge is behavioral. And this is one of those things where I'm not familiar with Orsted, sort of the fundamental components of Orsted on that chart on the left, but you can see certainly that was a mania that was sort of just kind of that sort of developed in the post-COVID world. And it's a lot of times we see this with companies where the fundamentals really haven't changed much. It's just really the perception of the future that has changed. And so behaviorally, as the manager, you can sort of sit that out and then understand where we've gone from, over optimism to over pessimism. That can be sort of an edge. And so again, just kind of tying it back, circling back to like the part of the presentation that's like marrying the quantitative, which is sort of the analytical framework, but also the fundamental, which we can tuck the behavioral sort of side into that. That's really where the managers in both of these are kind of recognizing, look, the market's gotten too over optimistic or too pessimistic and making a decision based on that too. So
great point. And that did come up a lot is, software was a big topic of conversation, that software is under threat because of AI. But some of the managers are saying, yeah, but the baby's being thrown out with the bathwater. All of these software companies are being treated like they're equally going to be disrupted by AI. And their point was that's not true when you look under the hood. So kind of before we get to questions, and diversifying your hedges is important. And then in an era of more positive inflation skew, higher correlations, we don't want to just look at cash and treasuries as a way to kind of buffer your risk or reduce your risk. There's got to be multiple things. Um, and so these are just some examples of kind of areas where there's some opportunity. And then, like Jeff said, with real assets, whether it's real estate infrastructure, energy infrastructure, precious metals, minerals, mining extraction, and then just different types of strategies like managed futures, things that don't correlate with stocks and bonds, that have some inflation hedging protection in them. We think that's a lot more relevant now than in the last, arguably 15 years, barring coming out of COVID, because that was such a dislocation. Okay. So we'll stop here. I thought I saw a question. A couple questions. Okay. Let's see. Okay. One question is, how much do we rely on T. Rowe Price analysis? I would say T. Rowe Price is a pretty significant input into kind of how we think about investing in the world, but it's not the only one. The other big asset manager that we have a relationship with, that we talk to the managers there, are able to talk to the analysts, is BlackRock, which BlackRock's actually a 15 to 16 trillion dollar asset management. T. Rowe's only 1.6 trillion. But I would say those are the two biggest inputs. And then we obviously do our own kind of analysis, just doing our own research. But what we figured out long ago was we don't have, if you talk to these analysts and portfolio managers and how they cover industries and how they cover companies and their knowledge of management, it's really, really hard to have an edge over a firm like T. Rowe on picking individual stocks. I'm not saying it can't happen from time to time, but as a repeatable process over a long period of time, we just can't. Most of these people will forget more than we'll ever know about a particular industry. I mean, it is that impressive. So we don't have an edge there, but where we do have an edge, I think, is asking really good questions and developing relationships with some of these analysts and managers that we can kind of develop and lean on over time. And that, I think, is a very significant edge that I don't know. I haven't met any other managers that have kind of, or financial advisors like our team, that have spent the years kind of developing those relationships and doing the due diligence. So it's kind of like Buffett's principle. When you find something that's of really high quality, you don't want to diversify it into 1,000 things. You want to focus on where the best quality is. Well, for us, we have found incredible insights from those two, from T. Rowe and also BlackRock. Probably a little bit more T. Rowe, but both. Would you add anything to that, Jeff?
I think it's good answer.
Do we think SpaceX could look like Orsted? I mean, you never know. I guess it could. I think for that, it's very much a function of, if you get the animal spirits, or everyone wants to flow into a SpaceX, retail gets into it in a very, very big way. Yeah, I mean, you could see all of a sudden the fundamentals, when they start actually doing their earnings calls and it doesn't match up with what their S1 said, you could see very, very big swings in the price. But I think it's speculation for me to say whether it's going to look like Orsted. Could it? Sure. I mean, it's priced at insanely high valuation, I think 100+ times revenue.
Yeah.
I mean, but then again, you're dealing with a CEO who is very unique, and you're getting Starlink, you're getting, right, the SpaceX, the rocket piece, but then you're also getting XAI,
mm-hmm.
right, which is essentially their own AI, and I think the model is Grok.
Right.
Yeah. So if Starlink continues on its trajectory and becomes kind of the default internet in the world, and then you start seeing, it's just so hard to to extrapolate out like space services, infrastructure in space, and what that looks like. I mean, I don't know, Jeff, if you have any, we don't have any.
I think I think you're right. I mean, at this point, I think it's gonna go public around $2 trillion.
Yeah,
Is, I mean,
one and a half to
that's what
two trillion.
so we won't know, but I mean, at 2 trillion, you have to start embedding a lot of assumptions and execution has to be pretty darn good. I mean, I think people have been talking about now data centers kind of launching them into space. And while I think that makes some sense,
It's a bit high in the sky.
yeah, we're probably a little bit further out from that being a reality than anything. I mean, Starlink, yeah, so there's real revenue. There's real products behind it. It's not a total wishful thinking, but yeah, 2 trillion, the execution needs to be pretty good for, I think, you to make some good money.
So next question is, you didn't mention crypto. Does it belong in this conversation? What is current 4J position on crypto? Current 4J position on crypto is that we do not recommend crypto to clients. If a client comes to us and wants to buy it, we will buy it on their behalf and advise them of the risk. But we still believe, crypto is fundamentally speculative because there are no one. It's a very new asset. I mean, it's been around for 15 years. People are calling it digital gold. I think I can see, I can see that. That makes sense to me. And I think so bottom line is right now, we don't have a definitive position. We think there's enough that we can buy in the markets outside of crypto where we can reach a client's goals, right? Get them into retirement and through retirement without running out of money. Does that mean crypto doesn't have a place? There's lots of arguments. I mean, don't think that we're not looking at it and reading about it all the time. We're always thinking about it. And, historically, if you look, a 1% position in crypto, right, has actually in a portfolio has been a good diversifier. But that's because crypto went from, Bitcoin went from what, $5 to 76,000. Okay, well, we'll see what happens from here. But yeah, we can't say too much about it. Next question, I think this is a big reason why crypto is part of the conversation, which is, at what point does the national debt matter? And will it take a catastrophic implosion in a sector such as AI infrastructure for this to really matter? And isn't this a big contributor to resulting inflation? So I don't know at what point the national debt will matter, because we feel like it should have mattered for the last 16 years. I think you are starting to see it show up in inflation. So I think the trillions of dollars that were spent during COVID, getting us through COVID, ended up being far too much. We didn't, no one knew at the time, but that kind of inundated the system with money for people to buy assets, sometimes speculatively, and to spend money. I still think that's happening. That's still working its way through the system. And to your point, the debt is going up because we're still running a deficit. We had a big tax cutting right? The big beautiful bill cut taxes, bigger refunds, more injections. So all of that is, I think, feeding into inflation. It's somebody compared it to we're driving, a car pretty fast into, a debt wall, but nobody knows when we're going to hit the debt wall. I mean, that's just the reality. But we are concerned about it. I think it is a real reason why we're, pivoting portfolios more toward to have a real asset exposure, whether it's global infrastructure or, extraction of minerals or precious, small amount of precious metals. And that's all kind of designed to be a hedge, and an inflation hedge. But short answer is, we don't know. I think as long as the dollar is the world's reserve currency, the implosion of a dollar seems to me to be a little bit, unlikely. But, look, things are changing. I mean, central banks around the world aren't buying dollars as much; they're buying gold. China being probably the biggest one. That I think that's a direct reflection. What you've seen in the price of gold is a direct reflection of this question, which is, this can't sustain itself.
Yeah, I mean, the only thing I would add to that is a good answer is, the credit default swaps, which is basically the cost of protection on Nvidia bonds is lower than treasuries. So this is something we've never seen before. And maybe that's a sign of peak optimism for AI. Who knows? We'll know in hindsight, I suppose. Um, but when corporations start, the investment community starts believing, hedging against corporate risk is cheaper than hedging against sovereign risk. We're in a unique situation. So, look, we've gone from structural 3% deficits pre-COVID to now, 5, 6, 7%, which seems like pretty consistently since COVID. I don't feel like that's a really sustainable long-term outcome. But when you look at countries like Japan, their debt to GDP levels have been far higher and not been sort of the reserve currency of the world. So it's probably longer than most people think, but it's something that politicians will need to sort of truly come to grips with, I think, at some point.
It's all really good questions, and I think the way we look at this, look, nothing is risk free, right? I mean, I think that is a super important point to remember, is that nothing is risk free. Even sitting in cash and treasuries, there's risk, right? There's risk, like you mentioned, the deficit. There's also inflation risk. If you're sitting in cash, you're getting 3 or 4%, but after taxes, you're probably not keeping pace with inflation, right? So in a year, that doesn't matter, but over 5, 7, 10 years, that's a pretty big kind of hole that's being burned in your pocket. So I think our position is always right. We start with the plan. We have to understand the whole situation. What are your income needs? How much you actually need the portfolio? And as many of you know have done this with us, right? That changes when Social Security starts, when the mortgage gets paid off, or when you get married, or somebody passes. Those numbers all change. So we got to have the plan right. And then from an investment perspective, you have to be in a portfolio that you can stick with. Like, you can stick with when times are good, and you can stick with when times are rough. And that's kind of the art of what we do, is trying to get that part right. It's not easy, but we do continue to believe that staying diversified and staying invested thoughtfully is actually kind of the optimal path for your financial future, right? And there's always going to be some headline or some pundit saying, "Oh, now's the time to get out of the market," or "I think is like." That's fine, but at the end of the day, when we build your portfolios and we build your plans and stress test, when we stress test it against not the market we're in now, we stress test it against the 2010s when the market didn't go anywhere for 10 years, right? So we do anticipate the next several years to be a lot more challenging than the last 3 to 4 years, but there also are different opportunities that are emerging that we're talking about here. So we're really happy that we had this good of a turnout. Love that we can convey kind of the information. So that we'll have this kind of sent out again so you can watch it on recording. We appreciate everyone's participation and attendance. And as always, we thank you for the business. So we'll talk soon.